Imagine a financial time machine that lets you look at a stock's price today, but decide to buy it at last year's price.
Right.
And at a massive discount on top of that. I mean, that is the magic of an employee stock purchase plan, or ESPP.
Yeah, it really is magic for the employees.
But navigating the regulatory and tax traps to actually build that time machine is notoriously tricky.
Extremely tricky.
We know you are prepping for a crucial exam on equity compensation. So we're relying on the NCEO's selected issues in equity compensation, specifically the 20th edition.
Right, chapters 11 and 12.
Exactly. And this deep dive is engineered to be your ultimate study session. Our mission isn't just to memorize the rules, but to really understand the fundamental logic behind them.
Which is so important for the exam.
Yeah. We're going to explore how these plans are constructed, how they're taxed, and ultimately, how to save future clients from a massive IRS double taxation nightmare.
And that real-world application is key. I mean, we're going to decode the underlying architecture of these plans so that when you sit down for that exam, you aren't just recalling isolated facts.
Right.
You're visualizing a complete interconnected system. And just to keep your reflexes sharp, we will weave 3 specific knowledge check scenarios directly into our conversation.
Awesome. So let's start with the architecture itself, from Chapter 11.
Let's do it.
Forget the idea of like an exclusive VIP club where only the executives get past the velvet rope. A qualified ESPP operates much more like a company-wide bulk buying syndicate.
That's a great way to put it.
The IRS grants this syndicate incredible tax advantages, but they demand a very steep price for admission, which is democratic access.
What's fascinating here is the sheer regulatory force of Section 423 of the Internal Revenue Code. Section 423 is, well, it's the golden ticket.
The golden ticket that unlocks all the tax deferrals we'll talk about later.
Exactly. But the IRS fundamentally hates tax shelters that only benefit the wealthy. So they created the Equal Rights and Privileges mandate.
Right.
If a company wants the Section 423 tax breaks, they cannot design an ESPP solely for the C-suite or the directors. The plan must be offered to substantially all employees on an equal basis.
Meaning, if you offer a fantastic discount to the CEO, you have to offer that exact same discount to the entry-level warehouse worker.
Precisely that. Now, I mean, the company isn't completely without control.
They can carve some people out, right?
Yeah, they can legally carve out a few very specific limited groups. Like they can exclude employees who have been with the company for less than 2 years.
Okay.
They can exclude part-time employees working 20 hours or less a week. And they can even exclude certain highly compensated employees as defined strictly by the tax code.
But beyond those permitted exclusions, the playing field basically has to be entirely level.
Yep. Every participant gets the exact same rights.
Okay, let's unpack this. Because if everyone is invited into this bulk buying syndicate, there have to be financial boundaries.
Right, obviously.
I mean, a company can't just give the stock away for pennies on the dollar without going bankrupt. The source material outlines 3 major guardrails for a Section 423 plan, starting with the discount itself.
Yeah, the discount is really the primary engine of the ESPP. Under Section 423, the maximum price discount a company can offer is 15%.
And that's calculated from the fair market value of the stock, right?
Exactly. Alongside that, the IRS mandates that an offering period, which is the window of time during which employees accumulate their payroll deductions to buy the stock, well, that period cannot exceed 27 months.
Which in the real world usually translates practically to a 24-month offering period.
Right.
Just to give the company a 3-month administrative buffer to handle the logistics.
That is a great way to think about it. And then we have the third guardrail, which is a hard ceiling on the employee. The IRS caps purchases at $25,000 worth of stock per calendar year.
Now, I want to push back on how that $25,000 limit is calculated, because this is a detail that trips up a lot of people on the exam.
It really does.
The limit is based on the fair market value of the stock on the grant date, meaning the very beginning of the offering period, not the actual purchase date.
Right.
That feels a bit counterintuitive to me. I mean, if I'm buying the stock 6 months later, shouldn't the limit be based on what it's worth when I actually buy it?
It seems counterintuitive until you look at it from the IRS's perspective regarding risk management. By pegging the limit to the grant date, the IRS locks in the maximum number of shares an employee can possibly acquire right at the start.
Oh, I see. It prevents an unpredictable windfall.
Exactly. Think about it. If a stock crashes from $100 down to $10 and the limit was based on the purchase date, an employee could suddenly buy thousands of shares.
Right. which would dramatically amplify their potential future tax advantage gains.
Yeah, the grant date rule keeps the scale of the benefit predictable for the government.
That makes total sense. It's basically a structural cap.
Uh-huh.
But let's get back to that 15% discount, because this is where the time machine feature comes into play.
Ah, yes. The look back.
Right. In the industry, it's called a look-back provision. With a look-back, the employee gets to apply their 15% discount to either the price at the beginning of the offering period or the price at the end on the purchase date.
Whichever is lower. It is arguably the most powerful wealth-building tool offered to everyday corporate employees.
It essentially removes the downside risk of market volatility. I mean, if the stock was $100 on the grant date and it skyrockets to $200 over 6 months, the time machine lets the employee look back to the beginning.
Right.
They apply their 15% discount to the $100 price. So they buy a $200 stock for just $85.
Exactly. And conversely, if the stock crashes to $50, the time machine looks at the new lower price, so they get to buy at a 15% discount off the 50.
Wow. Assuming they don't hold the stock during a further dip, it heavily stacks the deck in the employee's favor.
Which is why human resources departments view the look back as the ultimate retention tool. Employees are heavily incentivized to stay with the company to, see that purchase period through.
But as we'll discuss when we get to the corporate accounting side, that time machine creates massive internal tension within the company.
Oh, absolutely. It's a huge issue.
Well, let's lock in this architecture with our first knowledge check. So picture yourself sitting at the exam terminal, and the question asks, if you are advising a company on designing the most aggressive, employee-friendly Section 423 ESPP possible, what is the absolute maximum percentage discount you can legally offer, and what is the annual purchase limit per employee?
Well, based on the parameters we just explored, you would confidently select a 15% discount, paired with a $25,000 annual limit.
Based on the grant date, fair market value?
Right, the grant date. That's the key.
So we've built this incredibly generous, democratic bulk buying syndicate. Now we have to deal with the consequences.
There come the regulators.
Exactly.
Yeah.
The IRS and the corporate accountants enter the room, and they have entirely different agendas regarding these discounts and time machines. Let's start with the tax side.
Okay.
Because the golden rule of a Section 423 ESPP is that the employee does not pay taxes when they actually purchase the stock.
Right. That deferral is the primary benefit of the qualified plan. The taxable event doesn't actually occur until the employee eventually sells the shares.
But the IRS doesn't just hand out favorable tax rates blindly, right?
No, they definitely don't. They want to incentivize long-term investment in the economy. So they divide the landscape into two highly specific categories when you sell a qualifying disposition and a disqualifying disposition.
A qualifying disposition meaning the employee successfully jumped through the holding period hoops to unlock the best possible tax rate.
Yes, and the hoops are rigorous. To achieve a qualifying disposition, you must hold the stock for 2 years from the grant date.
Okay, 2 years from the grant.
And simultaneously, hold it for 1 year from the purchase date. If you satisfy both of those timelines, the tax treatment is bifurcated.
Meaning split into 2 parts.
Exactly. The original discount you received is taxed as ordinary income. But any further appreciation, all that massive upside from the time machine we talked about, that is taxed at the much lower long-term capital gains rate.
Got it. But if life happens and the employee sells early, say, the day after they buy the stock, that is a disqualifying disposition.
Right. A very common scenario.
In that case, the entire spread between what they paid and the fair market value on the purchase date is instantly classified as ordinary income, which is subject to higher tax brackets.
Yeah. The IRS severely penalizes the quick flip. However, there's a massive administrative perk tucked into the system that is crucial for your exam prep.
Oh, yeah. The 2004 Act.
Right, the American Jobs Creation Act of 2004. Congress decided that Section 423 ESPPs are exempt from tax withholding.
Which means no FICA or FUTA taxes.
Yeah.
And just as a quick refresher for you listening, FICA covers Social Security and Medicare taxes, while ET handles federal unemployment.
Right.
But why did Congress give companies a pass on this?
Well, if we connect this to the bigger picture, imagine the sheer nightmare for a corporate payroll department.
Yeah, man.
Yeah, imagine if they had to track exactly when thousands of different employees decided to sell their... the exact ordinary income component of each individual sale.
That sounds impossible.
It gets worse. Then they would have to somehow withhold Social Security and Medicare taxes from a regular paycheck to cover a stock transaction that happened through an outside broker. It would just paralyze the payroll system.
Oh, wow. So by entirely excluding ESPP income from FICA and FUTA, the government removed a massive administrative barrier.
Exactly. It encouraged more companies to offer these plans.
So what does this all mean for the internal corporate accountants? I mean, the IRS is playing nice with payroll, but the Financial Accounting Standards Board, the FASB, usually demands their pound of flesh when employees get a sweet deal.
And they absolutely do in this case. The FASB requires companies to follow Accounting Standards Codification Topic 718, or just ASC 718.
Right.
The core philosophy of ASC 718 is transparency for investors. If a company is giving away value to employees, the shareholders have a right to see that cost reflected on the income statement.
So accountants have to classify the ESPP.
Yep, as either non-compensatory or compensatory.
Non-compensatory meaning the plan is so vanilla that it doesn't count as an actual financial expense to the company. I imagine the thresholds for that are incredibly strict.
They are incredibly strict. To achieve non-compensatory status, the plan can have absolutely no option-like features.
So the look-back time machine is completely forbidden.
Completely. Furthermore, the discount cannot exceed 5%.
Only 5%. That hardly seems worth the effort for the employee to even enroll.
Well, the standard essentially dictates that a 5% discount is merely the reasonable cost of raising capital.
Oh, I see.
Yeah, it's equivalent to the underwriting fees a company would pay an investment bank to issue new shares to the public. It isn't considered employee compensation at all. It's just a corporate finance mechanism.
But if human resources demands that sweet 15% discount and the look-back feature because, they want to attract and retain top talent,
then the plan immediately becomes highly compensatory. The accounting department has to use complex mathematical models.
like Black-Scholes.
Exactly. They use that to calculate the fair value of that option-like benefit, and that value is then recorded as a direct accounting expense on the company's books.
So you are actively trading a lower corporate bottom line, which obviously impacts earnings per share, for higher employee satisfaction and retention.
Right. This is a constant push and pull in corporate boardrooms.
Which brings us to our second knowledge check. Let's apply this regulatory tension to an exam scenario. Under ASC 718, if a company's ESPP includes a 15% discount and a look-back feature, is the plan considered compensatory or non-compensatory for accounting purposes?
Using the logic we just discussed, the answer is definitively compensatory.
Because of the high discount.
Right. The 15% discount drastically exceeds the 5% safe harbor, and the look back is, well, it's the very definition of an option-like feature. The company must record an expense for that benefit.
Excellent. So we've designed the syndicate, we've navigated the IRS holding periods, and we've booked the corporate accounting expense.
You've done a lot.
Yeah. But we're still just talking about abstract numbers on a spreadsheet. How does the actual tangible stock physically end up in the employee's brokerage account so they can, actually sell it?
This is where we transition from the theoretical design of the plan to the mechanical reality. This brings us to Chapter 12. And the unsung hero of the entire equity compensation ecosystem, which is the transfer agent.
In the old days, I imagine this involved printing massive, ornate paper certificates and physically mailing them, just hoping they didn't get lost in transit.
Oh, it was a notoriously slow and vulnerable process. The transfer agent is the official legal custodian of the company's registered shareholder records. They're the entity that officially tracks who owns what.
Okay.
Today, when an ESPP purchase occurs, the company's equity team sends issuance instructions to the transfer agent. Then, the transfer agent debits the authorized, unissued shares from the company's master reserve.
And the source text points out a specific electronic protocol used for the delivery of those shares. DWAY-Hayes. That stands for Deposit Withdrawal at Custodian.
Yes. DWAC is essentially a highly secure digital handshake.
Between the transfer agent and the employee's retail broker.
Exactly. It completely eliminates the need for physical paper certificates. The transfer agent digitally pushes the newly minted shares directly into the employee's brokerage account, making the entire market move exponentially faster.
Here's where it gets really interesting, though. The transfer agent and the broker aren't just a delivery service anymore.
Far from it.
They are now at the center of a massive regulatory reporting trap that can absolutely ruin an employee's tax year if they aren't careful.
You're referring to the cost basis reporting nightmare. This is arguably the most critical real-world application of the material you are studying.
Exactly. The text highlights a major shift that started with the Emergency Economic Stabilization Act of 2008.
Right.
Beginning in 2011, the law forced transfer agents and brokers to start tracking the cost basis of covered shares. And cost basis just means the exact acquisition date and the purchase price.
Simple enough, right?
Right. When the employee eventually sells the stock, the broker is legally required to report that cost basis directly to the IRS on Form 1099-B.
On the surface, this sounds like a massive benefit to the taxpayer. I mean, the government is essentially mandating that the brokers do all the heavy mathematical lifting.
Right. I look at that rule and think, well, fantastic. I don't have to dig up a crinkled pay stub or a spreadsheet from 3 years ago to figure out what I paid for the stock. Shouldn't the broker just do all the math? But this is actually a massive trap. Why is this so dangerous for the employee?
Well, if we connect this to the bigger picture, specifically the ordinary income rules we discussed earlier, we see where the regulatory gears just violently grind against each other.
Okay, lay it out for us.
In 2014, the IRS instituted a new, very strict rule. Brokers are explicitly prohibited from adding the ordinary income component of an ESPP disqualifying disposition to the cost basis on that Form 1099-B.
Wait, really?
Yes. The broker is only allowed to report the actual discounted cash price the employee paid out of pocket.
Oh, wow. Let's walk through the math on that so the trap is crystal clear.
Good idea.
Let's say the fair market value of the stock is $100. With my 15% ESPP discount, I pay $85 in cash. I get the stock, and I immediately sell it for $100.
Okay, that's a classic disqualifying disposition.
Right. So my company's payroll department does their job correctly, and they report that $15 discount as ordinary income on my W-2.
Yep.
So I am fully paying my standard income tax on that $15.
That is correct. You have fulfilled your tax obligation on the discount via your W-2, but remember the 2014 rule.
Right.
Your broker then sends Form 1099-B to the IRS. The broker is legally forced to say you bought the stock for $85 and you sold it for $100. So the 1099-B shows a $15 capital gain.
But wait, if the W-2 already reported $15 of ordinary income and the broker's 1099-B just reported a $15 capital gain on the exact same transaction, I mean, IRS computers are going to look at those two separate forms and think I made $30.
And they will absolutely tax you on both. You will be double taxed on that same $15 of income unless you actively intervene.
That is insane.
It is. Because the broker cannot adjust the cost basis for you, the burden falls entirely on the taxpayer. The employee must manually adjust their capital gain or loss on IRS Form 8949.
So you have to literally write it in an adjustment code.
Yes, to back out the ordinary income that was already reported on your W-2, thereby zeroing out the capital gain.
This is why mastering this material matters so much.
Mm-hmm.
If you are advising clients or running an equity program and you don't actively educate your employees about Form 8949, you're essentially setting them up to hand over thousands of dollars in extra taxes to the IRS completely by mistake.
Completely by mistake.
Especially because so many people just use standard tax software, click Import 1099-B, and blindly trust the automated math.
It is a systemic compliance failure that happens constantly in the real world. The software imports the unadjusted $85 cost basis, and the double taxation is just locked in.
Which perfectly sets up our final knowledge check for the deep dive. Imagine a client comes to you in a panic after making a disqualifying disposition of their ESPP shares.
Okay.
They want to know who is legally responsible for adjusting the cost basis to prevent this double taxation. Is it their broker or is it the employee?
Well, based on the regulatory friction we just unpacked, the answer is definitively the employee. The broker is legally prohibited from including the ordinary income component in the reported cost basis.
So the employee has to do it.
Yes, the employee must manually execute the adjustment on Form 8949.
If you nailed that, you don't just understand the abstract theory, you really understand the downstream mechanics of equity compensation. You've survived the study session.
You really have.
To do a rapid-fire recap of the journey you just took, we started by building a Section 423 ESPP, acting as the architect ensuring equal rights and privileges. while staying firmly within the 15% discount and $25,000 grant date limits.
Exactly.
Then we navigated the IRS holding periods and the massive FICA tax exemptions, and then we crossed the aisle to calculate the ASC 718 compensatory expenses for the accounts.
A lot of ground covered.
Finally, we watched the transfer agent use the DWA system to digitally deliver the shares, all while successfully dodging the Form 8949 double taxation trap.
You've built an incredibly solid foundation for your exam. But before we wrap up, I want to leave you with a final provocative thought regarding the future of those transfer agents.
Oh, yeah. The settlement dates.
Right. The source text mentions a massive structural shift happening in the financial markets. Standard stock settlement dates are expected to shrink to T+1, meaning 1 business day after the transaction in May 2024.
So the window to process all of this complex data is basically being cut in half.
Exactly. If the window to settle stock transactions shrinks to a single day, think about the unprecedented speed pressure this places on transfer agents, brokers, and corporate equity teams.
They'll have to be perfect.
They will be forced to completely automate their data flows. With virtually zero margin for human error, will smaller companies even be able to manage a complex ESPP with a look-back feature without undergoing massive, expensive technological upgrades?
That's a great question.
It is a structural shift that will fundamentally redefine how these plans are administered in the real world.
It's the ultimate stress test of the system. I mean, you can design the most beautiful, employee-friendly bulk buying syndicate in the world. But if the digital infrastructure behind the scenes can't process the data at lightning speed, the whole program just grinds to a halt.
Very true.
Well, that's something to chew on as you walk into the testing center. Good luck on your exam. You are going to crush it. We'll see you on the next deep dive.